So how about giving us 3 stocks that you think look good for the rest of this year and why?
Yeah, I mean, last time I was here, sort of 12, 18 months ago, we had 3 stocks: Altium, Challenger and Healthscope. Altium's done extremely well, Challenger's done reasonably, Healthscope not so well. So hopefully we can replicate it this year and even go one better. The first one that we like at the moment is a company called Speedcast Global. Speedcast is a new age telecommunications business. They basically buy satellite space and provide internet connections to those industries that operate in remote locations. So think about shipping, for instance, think about offshore oil rigs. Speedcast are very, very prominent in that space. They deal with 9 out of 10 drilling infrastructure providers. So that's a business that's been winning a lot of contracts, not only in, say, the energy space, but also winning contracts with the US military, the NBN, for example. And although they've got probably an elevated level of debt compared to what we would normally like, they are generating a lot of free cash flow, which is expected to grow in the years to come as a lot of these contracts come to fruition. So that's the first one. The second one's a company called IDP Education, or ASX code IEL. These guys are an English language testing services provider. They also do student placements. It's a spin-off from Seek in 2015, but they've been delivering some very good growth numbers. Obviously, emerging middle classes in places like Asia have a very, very high regard for higher education in places like Australia, Canada and whatnot. In order for these students to go over and study in these places, more often than not, they need to be placed there firstly, but they need to pass certain English language testing. So that can be used for student placements, it can be used for migration intakes. Their most recent set of numbers were very, very strong. Their English testing services business was up about 30% in earnings. The student placement business was up about 45% in earnings. So although it's a company that would be considered an expensive high growth business trading on 35 times earnings, I think the growth numbers coming through are quite attractive for them. And then to cap it off, the last one is a company called Bapcor. These guys have been fairly stagnant over the past 12 months, range bound, but they are providing automotive aftermarket parts. So if you have an accident, take your car to the mechanic needs to track that part down from somewhere. Bapcor really do dominate that market. They've been probably unfairly treated to some extent, given they do have a retail arm, so auto barn stores people are probably familiar with. The threat of Amazon has probably been overblown in their case, given that the retail arm only makes up 20% of their earnings.
And let's face it, blokes like to go to places like Auto Barn and super cheap
that's
autos
right.
to look around for stuff.
And they've had a very good history of acquiring these businesses at very low multiples, incorporating them very successfully. Their debt level's blown out as well, but they're very quickly paying that off.
And they've done some acquisitions as well, haven't they?
That's right. Hellaby's in New Zealand's probably the most recent one, and that's performing quite well for them. So if they can manage to break above $6, I think fundamentally they're very sound and they're not trading on the lofty multiples of perhaps some of the other companies in the technology space.